Hello traders, welcome back to Dion Trades. Today we're breaking down inducements, which is one of the trickiest parts of market structure. Instead of thinking of inducements as a deep, advanced concept, imagine them as simply market traps set by big players. These traps make retail traders like you and me to think price is going our way. Then boom, market goes a totally different direction. Understanding inducements helps you avoid entering unnecessary trades and will help you differentiate fake demand and supply zones from real ones. By the end of today's video, inducements will finally make sense. You'll understand what they are, why they happen, and how to use them to protect yourself from unnecessary losses. If that sounds good, smash that like button and hit subscribe. It really helps. We also have a free Telegram channel now, where we share daily chart breakdowns and trade signals. The link is in the description below. And before we begin, this video is a response to one of my viewers, Ahmet Sarlar. Hope I pronounced your name correctly, my friend. And just like Ahmet, you too can suggest a topic for my next video. Alright, see you after the intro. Welcome back. Let's jump straight in. Before inducements make sense, you need to understand how price normally behaves. Don't worry, I'll make it very simple. No stress. No math.
I don't know. I never counted. I am not really a math guy, you know?
Price moves in three ways. Impulse, which is a strong move. Correction, which is a small pullback. And continuation, where trend gets back to its original direction. Think of it like walking your dog. You walk fast, you slow down, you keep walking again in the same direction. An impulse is when price moves fast in one direction. Strong momentum, clear intention. If the market had legs, this is where it would sprint like Ronaldo. Multiple small candles combine to make one big directional push. For example, bullish series of candles. Imagine price climbing step by step. Small candles, small pullbacks, but still climbing. That entire climb is one bullish impulse leg. No internal lows have been swept yet, meaning liquidity is still untouched. Institutions love this stage because they're building the trap. Subsequently, we have a valid pullback. Then price takes a small break, a pullback. This is normal. Think of it as the chart catching its breath. If the candle breaks below the previous small bullish candle, that's a minor correction. Then momentum comes back. Another small push. Another continuation. It's a simple rhythm. Push, then pull back, then push again. A corrective move is when price temporarily goes against the main trend. If trend is going up, the correction is a small downward move. If you ever bought right before a correction, you probably reacted like. A correction becomes valid when price breaks below the previous pullback low. Even a wick that sweeps the liquidity counts. When that happens, the market is telling you, this was not continuation, this was correction. Sometimes price moves upward with only small pullbacks, and none of them break lows. In that situation, the entire movement is considered one big impulse. This is where beginners mislabel things, and institutions laugh their lungs out.
Let me tell you something.
Let's simplify this. In a bullish market, a valid inducement happens when price makes a pullback, small red candles, then dips below the lowest point of that pullback. If it breaks below or just wicks below, liquidity is swept. That's your inducement. Think of the wick as the market whispering, "Let me just borrow some liquidity real quick."
Nice.
Picture this. Price is climbing nicely with small impulses and small pullbacks. Everything's smooth. Then suddenly it drops just enough to clean the previous low. That's inducement. This drop is not the market reversing. It's the market trying to get your money fast as liquidity to use it as fuel when returning to its original direction. So inducement is like a vehicle stopping by a gas station. Take the gas, which in this case is your stop losses, and get back on the road, continuing the same journey. In a bearish market, we have same rules but in reverse. Pullback candle makes a small high. Price wicks above that high. Liquidity above is swept. Then boom! We have inducement. There is one important rule. An inducement is not confirmed unless price also breaks a major high or low afterward. If you forget this rule, your trades will always feel like failed mission. But if you follow this rule, you avoid 90% of fake setups. For example, in a bullish market, when you see price break above the last major high, that tells you that structure has shifted upward and inducement is valid. Now the key is to find the internal pullback candle right before the breakout. Its low becomes your inducement level. That's where price often returns before continuing up. So after the breakout, you look left and identify right arrow the last red candle before price exploded upward. That low there, that's liquidity. Expect price to retrace down and take out the low, then reverse bullish again. When price sweeps it then bounces, that's your confirmation. A quick checklist before we continue. This is super important. Inducement is valid only when price takes out the internal pullback's lowest point, body or wick. Price retraces inside that pullback. If price does not simply touch and go, that's not inducement. If you get this wrong, you'll be staring at your chart crying every day. If price tries to sweep the low but fails, even by 1 pip, it is not inducement. This mistake destroys a lot of trading accounts, especially beginners. So why should we even care about inducements? It's simple. They tell you which order blocks are real and which ones are traps. Inducements help filter out 90% of fake zones that retail traders get tricked by. In a bullish example, when price closes above the last major high, 2 things happen. Number 1, a valid inducement is confirmed. And number 2, a valid break of structure, BOS, is formed. Both must happen together. That's a very important rule. So once we confirm the BOS, the next question becomes, where is the inducement area the market is likely to come back to? Before breaking the major high, price created a tiny internal pullback, that small bearish candle. The lowest point of that candle becomes our inducement level. We expect price to come back down, tap below that low, grab liquidity. And only then can you confirm that high as a new major high. It's that simple. If you don't understand, please rewind the video and watch as many times as you like until you understand, because this is important.
I have 4 words for you. Turn the volume up.
After sweeping the inducement, price usually taps into the extreme demand zone that caused the bullish move in the first place. It will bounce from there and continue with its bullish trend. Now let's jump onto a real chart and apply everything we've learned. You can clearly see the market is in a bearish trend, a series of pushdowns followed by small pullbacks. The upward push takes out the most recent pullback, which means the market has created a valid inducement. Since the inducement is valid, the low that was taken becomes a confirmed major low. Price then breaks below and closes under the major low, giving us a valid break of structure. This confirms the previous swing high as our recent major swing high. Now we need to identify the next potential inducement zone inside this bearish impulse. So first, we locate the latest internal pullback inside the impulse that caused the break of structure. This candle here is the latest internal pullback. What we expect is very simple. Price should push upwards, take out the high of this pullback, create an inducement, then continue with the bearish trend. Now let's see what happens. Price pushes upward but fails to break the pullback high, meaning no inducement formed. It immediately tries to drop again. Because the inducement didn't occur, this next drop does not confirm a major low. Let's continue. Price drops again and closes below the structure. But this is not a valid break of structure because of 2 reasons. Number 1, no inducement occurred beforehand, and number 2 is that the low it broke wasn't a valid major low anyway. So this break doesn't count. This whole bearish push is simply one long impulsive leg, not a structured move. Now we see the market forming new internal pullbacks inside the bearish impulse. This candle here is the latest internal pullback. We expect price to push up, break the high of this pullback, create an inducement, and then resume the bearish momentum. Looking at the internal pullbacks, the upper order block has higher probability. The lower one is more likely just an inducement zone, not a real order block. So our plan is to simply wait for price to push upwards, then sweep above the latest internal pullback. After grabbing liquidity from the inducement zone, then it will confirm this lower low as a major low and finally get a valid break of structure. Once a valid BOS forms, we can mark the supply zone that caused it. This supply zone has a high probability of reversing price. Remember, if there is no BOS, then there is no valid order block. Next, we simply wait for price to pull back into the supply zone. Let's see what happens. Price pushes up, sweeps liquidity, forms the inducement, and taps our higher probability supply zone. Once it mitigates the zone, price reverses sharply and creates a new break of structure. And that wraps it up. I hope this video helped you clearly understand inducements and how to use them in live markets. If you found value in this lesson, make sure to hit subscribe and turn on notifications so you never miss future breakdowns. Also, we now have a free Telegram channel where I share chart updates, quick trade breakdowns, and extra tips I don't post anywhere else. The link is in the description, so join us for free and level up your trading knowledge. Drop your questions or video ideas in the comments. I'd love to hear what you want me to cover next. Thanks for watching, and I'll see you in the next video.